Another thing that that Arup said that was very interesting, and again, I think a fundamental choice, or at least a point on a continuous spectrum, is the focus on investment management versus asset gathering. Kevin, you're starting up a fund. You probably wouldn't mind having some assets gathered. I mean, we all would like to have some more assets. But
if anybody here wants to give any other side at the end.
But I think it's also very true that a focus on sales may get some assets, and of course it's got to be backed up by investment. But if you do get all those assets and you don't have a way to invest them, that's a quality way to invest them, and it'll be a bit like the dog who finally caught the car and doesn't know what to do with them. And so how do you balance that? Because you do have to pay the rent with assets. But
I think there's a couple simple rules, and Arup said one, and I believe in it. And we have a clean sheet of paper, so we can do that. It's a ratio of investment people to marketing people. When the ratio is 100 to 1 on the marketing side, it's a different institution. If we can keep the ratio small, I think that's one way to measure it. The other area, which I think is a debate going on, and it was really hot last year, especially in the hedge fund space, but after you had a 64% up market, nobody cared anymore about fees. I think the level of fees, people like Jack have to decide that, what's appropriate. If you're delivering amazing performance and some of these for 15 years, 24% annualized return, maybe they can charge a 2 and 20, or if you're a great performing mutual fund, you can charge over 100 basis points. But I think to think how your managers are spending those fees, if you decompose the fee spend, are they, you're paying them to manage money, but they're taking 80 to 90% of those fees not to invest in their investment professionals or infrastructure, but to go gather more assets. And that piece, I think, is the debate that kind of has to wake up here. The level, that's supply and demand and quality, and how managers are spending that.
We had a situation a few years ago. It was an international manager out of London doing international equities, and their sweet spot was about 10 to 12 billion. And that's what we invested in, and they made investments based upon that type of structure. And they went out and they hired more people to gather more money in, and pretty soon they were up to about 28 billion. And the investments were tanking because there wasn't what they were used to doing. It was just they had to make bigger and bigger bets. And so we discharged them. And a lot of other people did too.
Yeah, certainly capacity is, like I said, the dog who caught the car. Jack, how do you think about fees? Kevin brought up, well,
Make them low.
Do you drill into how the firms are spending your fee money? Do you think about that?
Yeah, we do, but we don't do it ourselves. We use our consultants. I mean, our City of Boston Pension Fund, we have no professional staff. Most of the staff that is involved in disabilities to the employees. But we let that up to our consultants to go in and drill down on us. We are concerned about fees.
Of course.
Can I add something there?
Please.
Other thing which always surprises me is, we have a good blend of performance fee and fixed fee assets. And that's a performance fee is one way where the interests of the client and the manager is generally aligned, so long it's structured properly. There are many ways to structure performance fees. So even today, I'm sometimes surprised when we win some mandates and some clients sometimes say that they won't look at performance fees. Because I would say, so long as they're structured properly, they align both the interests.
We'll look at them.
Yeah. It seems. I'm sure there are ways to game it, but it seems like it's a pretty solid a way to match fees to performance. And Arup, you talked about the ratio of sales professionals to investment professionals. Surely there are some sales professionals at Numeric, but you can talk about that the focus of the firm being on investments versus asset gathering. How do you maintain that philosophy? Because it's very easy, as we all know, someone to make it rain and say, well, let me do more of this. I need to.
So I think the first time we spoke it was called AMER conference. This was in 97 or 98, and it was a colleague of mine who spoke at the conference talking about capacity management across all strata, including U.S. large caps. That is, beyond a certain point, it's hard to manage money. Exactly what Jack was talking about. It's definitely a big issue in emerging markets, small caps, but also becomes a big issue in large caps once you get beyond a certain threshold. So the way we fight it, it's absolutely right. I mean, there's always this tussle in any firm between marketing and investment, and it's a good tussle usually,
It's healthy.
But I would say it's good for the firm that both sides, are trying to figure out what's best for the firm. But I would say ultimately, if you have capacity management in place, and we have always had that, we have capacity limits on all of our products, and if you have that in place, then you have a control there. That is,
right.
if someone's
it's
raising money at
number.
some point,
Yeah.
it stops, and
right.
you say, it'll be hard for me to generate alpha, which means it'll be hard for you to sell the assets in the future. Maybe you can sell it now. So you're creating a problem 3 years down the road.
Mm-hmm.
So we try to block it before it gets there. And there were times when 3/4 of our assets, our strategies were shut to new investors. I mean, given what's happened in the last couple of years, obviously that's not the case anymore.
Mm-hmm. And if you do have a lot of products that are closed to new investors, I think that can be a difficult situation because the current investors say, well, you've got this product, you don't need such high fees, but then you run out of new money to invest in new products. Kevin, you've been at a lot of firms prior to your current one. What how do you maintain the flow of revenue to reinvest in new products that will then generate new revenue because they have the capacity?
Well, the first question you have to ask, is it truly a new product? There's only so many flavors of what we do. And a lot of times it's things that are just rewrapped. If it's a custom application for a large institutional client, that certainly can be interesting and that may justify a specialized fee. But I think whenever you do this and having capacity constraints, you're telling what your limits are very important, but you have to say, are what we're doing, is it based on our core competency, our core philosophy, and is this something that is a spoke off of what we've proven that we can do? Or are we just going to say, this is hot and we're going to get in this area? The nice thing about the downturn that we've seen in some ways is that if everybody rewinds to July 2007, everything was fine, and probably everybody's firm had a bunch of stuff on the drawing board they were going to get into. Right? That's gone away. So in some ways that's healthy, but I think it's very difficult for a firm to say we're going to do something completely new and different that we've proven ourselves on, and when they do that, history says it generally doesn't work out.
Interesting. So we can talk a little bit about. We talked a little bit about how to meet clients' needs. Arup, you have these multiple products, but they're all quantitatively managed. Do you find clients are looking for a quantitative product versus a fundamental product, or are they a little gun shy about quantitative methods right now?
Depends on the environment.
Well,
and today, definitely people, I would say the best stat I give is, and I do a lot of the finals as the investment person at Numeric as a finals presenter, and I would say that 4 or 5 years back, if there were 4 finalists for any search, it was not atypical to have 2 quants out of the 4 finalists, because quants were in vogue that had great alpha from 2000 to 2003, and money was chasing alpha. Today, it's rare to find more than, if we are one of the finalists, it's rare to find another quant. I haven't found another quant in any of the finals in the last 1 year I've been in. So that tells you that obviously the quant struggles, which my view is a lot related to the massive global financial crisis we have had. Quant or disciplined processes, in my view, don't do as well in a very macro-driven environment. Extreme macro-driven focus, quant or disciplined stock-picking approaches like what we do struggle to some degree. And that's true for all other quants as far as I know. So I would say, therefore, it's more lonely at finals these days as a quant compared to before. And there's definitely more education that needs to be done. But having said that, I mean, maybe I'm just going to ruin my luck so far this year, but we have had a 100% hit ratio in finals this year, going up against fundamental managers in the few finals we have been at, which to me is a difficult thing to do in today's environment, because I would say things are stacked against quants generally.
Mhm. Jack, in the finals that you've done in the recent past, what have the participants mirrored Arup's observations?
They have somewhat, yeah. We have a pretty broad, diversified portfolio. We have quant managers and new managers, and we should try to balance them over a period of time, how we look at them.
So you do look at, when you're doing a search, you do look at whether it's a quant large cap value or it's a fundamental large cap value?
Yes, we do.
Okay.
Yeah.
And is your analysis of the managers quantitative itself, a lot of style analysis and that kind of thing?
It is, but we leave that up to our advisors to do that.
Mhm.
And then they come to us with the final product and make recommendations.
I see.
Usually 2 or 3 managers. And then we review those managers, have them come in, review their background and what they've been doing and their success or failure. And then we make a decision.
Mhm.
See, we don't have any professional people on our staff.
Mhm.
So we have 5 trustees. And we've been doing this for a while. We've been doing it quite successfully, actually.
Yeah, 70% is, as you said, pretty successful for a public plan.
This past year, first quarter of this year, we were up about 3.8%. And then for a trailing 12 months, we're up about 37%.
Great.